Welcome back to The Deep Dive, your ultimate shortcut to being well-informed. Today, we're plunging headfirst into the second quarter 2025 earnings call for ACRE's Commercial Realty Corp. We've sifted through the reports, the analyst notes, the full transcript, basically everything. Our mission to bring you the essential nuggets, the key insights. We want to help you unpack the numbers, understand management's strategic vision, and, well, figure out what it all means for you navigating today's market.
That's right. Because, look, on the surface, ACRE's presented some, let's say, conflicting signals in Q2. You had this headline GAAP EPS loss, but then also some surprisingly strong operational metrics underneath. So we're going to analyze the true state of their financial health, really dig into their loan portfolio's credit quality, and explore how they plan to grow in what's still, let's face it, a challenging commercial real estate environment. Our goal is to give you that broader context, those critical implications you need to stay ahead of the curve.
Okay, let's unpack those headline numbers first. They really set the stage for this whole deep dive. For Q2 2025, ACRE's reported a GAAP EPS loss of $0.10.
Now, that figure actually came in below street expectations, and the range was pretty wide, wasn't it? Like a profit of 17 cents down to a loss of 55 cents.
Yeah, exactly. A very wide range, and they still managed to come in below it. So definitely a miss on that accounting front.
Right, but here's where it gets interesting. Like you said, the conflicting signals. They're non-GAAP earnings available for distribution, or EAD.
Which you should think of as sort of their core operational cash flow, the stuff they could actually distribute.
Exactly. That was positive at $0.04 per share. And what's really striking is the comparison to last quarter.
Oh, absolutely. It's a significant turnaround from a loss of $0.86 per share just in Q1. So you've got this GAAP loss on one hand, but this, very positive operational swing on the other. That's the tension right there. A $0.04 positive EAD after an utter 86 cents loss in Q1. I mean, that's a massive pivot. So first big takeaway for you listening, don't just stop at that GAAP loss. The actual operational cash flow seems to tell a different story. And what about total revenue?
Total revenue for the quarter came in around $21.9 million, which, suggests a fairly stable base, again, kind of reinforcing that operational picture rather than the GAAP one.
Okay. And book value per share, I saw some movement there too.
Right. It saw a slight sequential decrease down to $27.93 from $28.50 in Q1. But, and this is important context if you zoom out a bit, it was actually up from $27.20 in Q2 of last year, 2024. So yeah, bit of a mixed picture depending on your time frame. Down quarter over quarter, up year over year.
Got it. And liquidity. Always crucial in real estate. How are they looking on cash?
Absolutely critical. Yeah, they maintained a solid position there. Ended the quarter with $64.7 million in available liquidity. That's split between $43 million of unrestricted cash and about $22 million projected from financing available on unlevered assets. So decent flexibility.
And how did the market react to all this? Or with the mixed signals, I mean?
Well, that's really interesting, too. The immediate reaction was frankly pretty muted. The stock stayed largely flat during the call itself, which kind of indicates a neutral, maybe a wait-and-see reception despite that headline GAAP miss. The market wasn't, popping champagne over the EAD, but it wasn't panicking over the GAAP loss either. Just watch it.
Okay, so headlines covered. GAAP loss, big EAD improvement, mixed book value, stable liquidity, muted market reaction. Now, let's really pull back the layers, dig into the operational details. What drove these numbers, especially that GAAP loss of $732,000 for common shares, and how did they swing that EAD so dramatically?
Excellent question. That headline GAAP loss, $732K, it catches the eye, but let's break it down. The really big swing factor was actually a significant improvement in net interest income. Came in at $8.6 million. That's a $3 million jump just from Q1.
Wow, $3 million jump in NII. Okay, where did that come from?
It wasn't just one thing. Two key drivers. First, about $1 million came from lower financing costs. That's thanks to their new facility kicking in, a direct operational saving.
Okay, $1 million just from better financing. That's substantial. What else?
Even more impactful, actually, was the non-recurrence of $1.5 million in accelerated deferred financing charges. These were tied to prior securitization vehicles. Basically, some one-off accounting drag from Q1 just didn't happen again in Q2.
So less about new income, more about less old baggage.
Exactly. A good chunk of that EAD improvement wasn't necessarily new money coming in the door, but just a cleaner quarter. Removing some of those prior accounting headwinds made a big difference.
So trimming expenses and shedding some one-off costs. Powerful combo for EAD. And I also noticed their net real estate operations improved quite a bit. Went from a larger loss to just a tiny loss of $77,000 this quarter, and that included $1.2 million in depreciation.
It absolutely did. And that improvement came largely from better operating performance from their owned hotels. It shows their hands-on management efforts seem to be paying off in those specific assets they control directly.
Okay, good to see. But this brings us to the big one in CRE. Credit quality. How's the loan book looking?
Right, always the elephant in the room. We actually saw a decrease in current expected credit losses, the CECL reserves, down by $780,000, which works out to about 11 cents per share.
A decrease in CECL. That sounds positive, like they see less risk.
Well, on the surface, yes. The total allowance for credit losses is now $30.3 million. That's about 2.18% of their $1.4 billion loan portfolio. And the decrease was, according to them, primarily due to improvements in their modeled credit risk. So their internal view improved.
I feel a bud coming.
You got it. But this positive internal signal was somewhat offset by, quote, a general worsening of broader macroeconomic factors impacting credit. So it's this tension again. Their models say things are looking a bit better internally, but the big picture, the external economy, still looks tough. They're acknowledging both.
Internal strength versus external headwinds. Got it. Now let's pivot to capital management. How are they using their money? I saw they bought back shares.
They did. Repurchased 272,000 common shares for $5.1 million during Q2. And notably, they bought them at roughly a 33% discount to their stated book value.
Wow, 33% discount. That's management saying, our stock is cheap.
Pretty much, yeah. It's a clear signal they believe the shares are undervalued, and they still have about $5.4 million left on that buyback program, so potentially more to come. And here's something else, kind of a hidden asset for ACRES, their NOLs. Net operating losses.
Right, NOLs, tax credits, essentially. How much are we talking?
They're sitting on $32.1 million in NOLs. That works out to roughly $4.45 per share. And management specifically called these out as a strategic asset.
Why strategic? How does that help them and you, the listener?
Well, it's not just some accounting footnote. It's a powerful tool. It means ACRES can shield future profits from taxes for a while. So when they do return to sustained profitability, they can retain those earnings. Reinvest them back into the business, grow book value, whatever, without immediately sending a chunk off to the tax man. It's like having a tax-free growth booster waiting to be activated.
Okay, that's a significant potential advantage down the road. Let's shift focus to the actual loans, the core business. Ended Q2 with $1.4 billion in CRE loans spread across 48 investments. The weighted average risk rating held steady at 2.9. That sounds okay.
It does sound okay, stable on average, but you have to look a bit closer. The number of loans rated 4 or 5, those are their higher risk categories, actually ticked up by 2, now stands at 13.
13 loans in the higher risk buckets. Is that a major concern or just noise?
It's definitely something you as an investor need to watch closely. While the average is stable, that increase in the 4s and 5s, those are the loans management is actively worried about. They could be heading towards default, needing workouts. The call suggested these are often older office or maybe certain retail assets where the market's just tougher. So it points to specific stress points, even if the overall portfolio average looks all right.
Right, averages can hide things. What about actual payment status, defaults?
Well, the good news is 91.4% of the portfolio by par value is current on payments. That's still quite high. But it is notable that 5 loans are currently in maturity default. So they've reached the end of their term and haven't paid back yet. Work in progress there.
Okay. And the mix of properties, still heavily multifamily.
Very much so. Multifamily makes up 75% of their CRE loan exposure, dominant segment for them. Office is next at about 17.9%. And crucially, remember, the entire whole loan book is floating rate. It's SOFR indexed, with a weighted average spread over SOFR of plus 3.65%.
Floating rate in this environment, risky. How are they mitigating that?
Good question. They pointed out that 62% of the par value of their loans has protection, either through interest rate caps or debt service reserves held by the borrower. These are really crucial design features right now to buffer borrowers and therefore ACRES from sharp rate increases impacting payments.
Smart move.
Oh.
Okay, so managing risk there. What about actual growth? Were they originating new loans?
They were. Net CRE loan production for the quarter was $60.5 million. That came from new commitments totaling $72 million, offset by about $17.6 million in loan payoffs and paydowns. So yeah, a net increase in the loan portfolio. They're still doing deals.
That net increase shows some forward momentum. And looking ahead, management seemed pretty bullish on growth, right? Big targets.
Yeah, quite ambitious, actually. They plan to grow the portfolio by $300 million to $500 million through the end of this year, specifically targeting, in their words, high-quality properties. And they also expect to redeploy capital from selling some existing real estate they own directly into these new loans, a strategic rotation.
Okay, $300 to $500 million growth target by year end. How do they fund that? Leverage.
Yep, leverage is part of the plan. Their GAAP debt-to-equity ratio nudged up slightly to 3 times, and management said they aim to comfortably increase this, maybe to 3.5, perhaps even 4 times. But, and this is key, primarily using non-recourse CLO financing, collateralized loan obligations.
Non-recourse. Explain that quickly for our listeners. Why is that important?
Super important. Non-recourse means the debt is secured only by the specific pool of loans in the CLO. If those loans go bad, the lenders can only claim those assets, not other assets of ACRES itself. It contains the risk, unlike recourse debt, which puts the whole company on the hook.
Got it. So leveraging up, but in a generally safer, more contained way. Do they have concrete plans for the CLO financing?
They do. They confirm they intend to execute another CLO deal. Likely time frame is Q4 of this year, 2025, or maybe Q1 2026. That's the mechanism to support those big growth targets without piling on corporate risk.
Makes sense. Okay, one last big piece from the call, the dividend. Always on investors' minds. What's the story there?
Yeah, the inevitable dead-end question. Management was clear. Reinstating it is contingent on a few things. 1, monetizing some of those existing real estate assets they own. 2, actually hitting those loan portfolio growth targets. And 3, achieving sufficient EAD growth to cover it comfortably. So basically, sell some stuff, grow the loan book, make enough operational cash flow, then maybe the dividend returns. Clear milestones to watch.
Okay, that's a very clear roadmap. So stepping back, this deep dive really shows those conflicting signals you mentioned at the start. The GAAP EPS misgrabbed headlines create that misnarrative. But underneath, you have this strong EAD growth, stable operations. It paints a much more nuanced picture. It's definitely not a simple story.
Exactly. And what's fascinating is how management's story focused on growth, quality properties. The CLO strategy kind of clashed with the market's immediate focus on that GAAP number. That divergence, I think, explains that muted, range-bound stock reaction we saw. The market was like, okay, which story do we believe? Trying to reconcile the two narratives.
So for you, the investor listening, what's the takeaway here? It seems like a company carefully picking its spots in a tough market.
I think that's fair. They're strategically navigating a challenging CRE environment. Let's not forget the broader market is still facing headwinds. We saw those CMBS delinquency rates tick up again in July and August to 7.29%. Credit friction is still very real out there.
But ACRES is mostly multifamily, right? How's that specific sector looking?
Right, 75% exposure. And for multifamily, the outlook is, let's say, cautiously constructive. Rent growth has been kind of modest because of new supply hitting the market, but renewal growth for existing tenants is still positive, and critically, new construction starts are finally cooling off. That could lead to better market conditions in 2026, assuming credit stabilizes. So maybe some light at the end of the tunnel for their core segment.
Okay, so given all that context, the company's strategy, the market backdrop, what should you be watching closely? Key signposts for ACRES going forward.
All right, key things to monitor. First, any news on resolving those non-performing assets we talked about, payoffs, workouts, sales, need to see progress there. Second, updates on their Q3 and Q4 origination pace. Are they actually hitting that $300, $500 million growth target? Third, credit milestones on those 13 higher risk loans. Do they improve, worsen, get resolved? And then finally, the broader macro stuff, CMBS trends, interest rates, how's the external environment playing out? Ultimately, you want to see a sustained pickup in EAD combined with stable book value. That would really validate management's whole strategy.
Excellent checklist. All right, let's shift gears. It's time for our This Is Not Financial Advice segment. Let's brainstorm an outrageous but plausible trade idea based on everything we've just discussed.
Okay, let's play with this. Given ACRES' very specific goal, grow by $300, $500 million by year end, mostly in high-quality multifamily, and their plan to use non-recourse CLO financing in Q4, Q1 to lever up smartly to maybe 3.5x, even 4x.
How about this? You go long ACRES, but you hedge it. You short a different commercial mortgage REIT, maybe one that's more broadly diversified, higher leveraged overall, and crucially has significant exposure to challenged sectors like office.
Interesting. A relative value play. What's the core thesis?
The thesis is that ACRES, with its laser focus on quality multifamily, its smart non-recourse financing strategy, and that in OLML asset cushioning future taxes, could actually outperform peers who are more broadly exposed to the ongoing credit issues and supply headaches in sectors like office or maybe even some types of retail.
So you're betting on specialization and execution winning out over broad market exposure in a tough environment.
Exactly. And if they successfully execute that next CLO, that could really boost EA and returns, potentially without adding perceived risk because it's non-recourse. That event, plus continued EA growth, might trigger a re-rating. The market could start pricing in a dividend returning in 2026.
So you're essentially betting on ACRES' specific targeted strategy asset selection, financing execution to generate alpha against a sector that's still broadly stressed.
Precisely. It's a bet on their ability to execute their specific plan in this market. Outrageous but plausible.
Plausible, definitely. Requires good execution from them, though.
Absolutely.
Yeah.
Okay, let's recap our deep dive today. ACRES Commercial Realty Corp reported that Q2 GAAP EPS loss, yes, but also that positive EAD. A mixed picture, but operationally stable, maybe even improving. It definitely wasn't a simple story of just a miss.
Right. And management seems clearly committed to their plan. Grow the loan portfolio, focus on high-quality multifamily, use those NOLs, use non-recourse financing. They're trying to enhance shareholder value through pretty active management and strategic capital deployment.
The broader CRE market. Still challenging, no doubt about it. But ACRES seems to be leaning into the credit workouts, so selective new loans. They're not just sitting back. And there are clear catalysts, like we discussed, for you to watch for signs of sustained improvement.
As always, we strongly encourage you to do your own due diligence, your own research. Look for those specific milestones: loan growth, credit updates, EAD trajectory, the CLO execution.
And maybe a final thought for you to mull over. In a market that throws so many mixed signals, how often do we miss the real story by just grabbing onto the headline? ACRES Q2 report is, I think, a potent reminder to always dig deeper. We really appreciate your time today. We welcome your questions, your feedback. Thank you for tuning in to The Deep Dive.